Japan's yen rescue exposed a bigger problem. Japan spent billions of dollars to support its currency. The US backed Japan. Even South Korea joined the effort. Yet within hours, the yen started falling again. So why didn't it work? What happened? Japan stepped into the currency market to support the yen. The US publicly backed Japan's move. South Korea also coordinated with both countries. Investors expected the Bank of Japan, BOJ, to signal more rate hikes. Instead, the BOJ kept interest rates unchanged and gave a confusing message. The yen briefly recovered before falling back near its earlier levels. Why does Japan even care about the yen? The yen is Japan's currency. When the yen falls, Japan has to pay more for imported oil, gas and food because those are bought in US dollars. That increases costs for businesses, pushes inflation higher, and makes life more expensive for households. That's why Japan sometimes sells its dollar reserves and buys yen in the market. This is called currency intervention. The goal is simple: increase demand for the yen so its value rises. But intervention alone rarely works for long. Markets also want to know whether the central bank is willing to support that move. Why was everyone watching the Bank of Japan? A central bank has one powerful tool: interest rates. If Japan raises interest rates, investors can earn better returns by holding Japanese assets. That attracts foreign money, increasing demand for the yen. That's why traders expected the Bank of Japan to hint that more rate hikes could come. Instead, the bank kept rates unchanged and used cautious, technical language. There was no strong message saying, if inflation stays high, we are ready to raise rates. Without that confidence, investors quickly sold the yen again. Why isn't intervention enough? Think of intervention as pushing a ball uphill. You can push it once, but if nothing else changes, gravity pulls it back down. The same happens in currency markets. Japan can spend billions buying yen, but global investors trade trillions of dollars every day. If interest rates remain low and investors still believe the yen will weaken, they will continue selling it. That's why central banks usually combine intervention with clear monetary policy. Without both working together, the impact fades quickly. Bottom line: Japan proved it can slow the yen's fall, but to reverse the trend, it needs more than dollar sales. Markets want a clear signal that the Bank of Japan is ready to fight inflation with higher interest rates if needed.